Good morning and welcome to the third in this series of IMAP webinars. Through this series, we've been looking at the global equity opportunities and doing so in the context of some really significant geopolitical events. One of the things we've had the opportunity to consider through the last 2 days has been the potential impact of geopolitics. It's been very interesting to me in listening to the 4 speakers that we've had to date to pick up on the various themes that have come out of their presentations. And if I was to summarize those, it's probably taking a view on the level of economic growth that we're likely to experience over the next 24 months. A view on US markets and whether the very significant returns that investors have achieved from those markets over a long period of time are likely to be continued, or whether other markets represent better opportunities. And of course, the role of AI. And we're going to be talking more in depth about that, in addition to the considered views on geopolitics in today's session, the final in this series of 3. Before I invite Andrew Stewart and Tom King to join us, let me just say a little about our upcoming events through the rest of this calendar year. In a couple of weeks' time in Sydney and Melbourne, Portfolio Management Conference, we'll pick up on both this topic of global equities investing and also private markets. And looking at the agendas, we really have a fascinating set of presentations from both global presenters and Australian managers. In July, Advice and Action will focus on high net worth investing and the delivery of managed account services to high net worth investors. In September, IMAP will host the Alternatives in Discretionary Portfolio Management afternoon as part of Sydney Alternatives Week. So that'll be an opportunity to pick up on private market investing, private equity, private credit, alternatives, hedge funds, and the opportunities and issues that they give rise to in discretionary portfolios, MDAs and SMAs. In October, Independent Thought is an opportunity for us to showcase the thinking of the portfolio managers and asset consultants and the way in which, as we near the end of the year, they're thinking about the construction of portfolios. And then a new thing for us in a specific MDA conference in November. This will be an important year for MDA advisors, MDA providers, because in this year, ASIC will be rolling over the MDA instrument. So they've told us that they expect to release that instrument in October. So we'll be hosting the MDA Providers Symposium in Sydney, a day-and-a-half conference, at which we can then understand what the implications of any changes which ASIC has implemented in the MDA instrument will be for advisors and MDA providers. Now on the screen is a QR code which enables you to link to the agenda for the IMAP Portfolio Management Conferences. If you photograph that or take a screenshot of that QR code, you can link to the agendas. And if you're an advisor, there's an opportunity there from the email address support@imap.asn.au to apply for a complimentary ticket to the Portfolio Management Conference in either Sydney or Melbourne. We welcome the questions, and we've had excellent questions over the last couple of days. So I'd encourage you, as you listen to Andrew and Tom, or as other issues seem to you to be important, ask a question, and we'll address that as we go. But it's now my pleasure to hand over to Andrew Stewart. Andrew is a principal with Mercer Consulting, Mercer Investments, based in Sydney, and his main responsibilities involve leading selection of investment managers and strategies in a managed account context. So, Andrew, over to you. Thanks very much.
Thanks, Toby. So I think it would be best to start today's webinar just in terms of our positioning heading into 2026. A little bit of a high level overview of our thoughts around markets and the economy. And I think just more broadly, the theme for us this year is really trying to find pockets of opportunity where they exist within markets. Obviously, there's been a lot of dislocation over the first 7 to 8 weeks of this calendar year. So it's really trying to establish that opportunity set and really trying to sift through the noise in terms of where are the alpha drivers over the course of this year. Global outlook in our view for this calendar year, probably it can be summed up as relatively bullish. Growth we think will continue to be well supportive within the global markets. We think trendline growth is certainly an outcome, especially within the US and some parts of Europe over the course of this calendar year. Really supported by AI capex spending, I guess more stimulatory monetary and fiscal policies. And so we are thinking of a little bit more of a supportive growth environment for the course of this calendar year. That might diverge compared to other regions such as Australia, but more broadly, we think growth and economic growth globally should support equities as we head into this calendar year. Inflation, we think, will be fairly benign. Inflation pressure should recede over the course of 2026. We think that, whilst we may see some lagged impact from tariffs, they are probably played out within markets to a certain degree for now. And as such, we think that labour markets and more of a benign wage growth will lead to, more of a de-inflationary or a recession or recede in overall inflationary outcomes across the globe over the course of this calendar year. With regards to central banks, we think that monetary and fiscal policy will continue to act as a stimulus. We do think that the interest rate cutting cycle that we are seeing across many developed market and emerging market economies, or we have seen over the last 18 months, will begin to pull back a little bit over the course of this year. But in response to more of a benign inflation environment, we are expecting the Fed to incorporate a couple of cuts over the course of 26. So all those factors are relatively well supported for growth markets and equities in general. We think that there are a number of key risks, however. You've seen geopolitics pop up over the course of the weekend, but one thing I would say to advisors and to the broader wealth channels is that, there are upside risks to our narratives as well. If we see increased productivity, increased fiscal stimulus, we, in our view, are moving from a relatively bullish scenario into quite of a strong bullish scenario. So, in our view, advisors and the broader wealth community need to really flexible as we head into this year, really try to identify some of those opportunities that are within markets, and also be able to respond to kind of short to market term periods of volatility. Now, moving on to the next slide, how this translates into specific asset classes. We are quite bullish on equities. Again, that very strong or that growth environment heading into 26 should be quite supportive of general developed market equities. We think that fiscal stimulus, especially in the US, should lend itself well to growth assets in general. We are balancing that a little bit against valuations. They do seem quite extreme in some areas. So it is a little bit of a neutral outlook. However, just this backdrop of a relatively strong macro environment should lend itself well to equities. Government bonds are a little bit more selective, and that's going back to that point around finding the best opportunities. We like the UK. We don't like the US right now in terms of purchasing government bonds. We think the market's got a little bit of its head of itself in terms of interest rate cuts. So we are a little bit underweight with regards to the US. Australia looks quite interesting. It is quite data dependent. However, so we are taking a little bit of a neutral approach there. Credit, whilst we do like corporate balance sheets, we think that economic growth is strong. Spreads are quite tight right now, historically tight. And so we don't think the valuations are there for IG credit or even to a certain degree high yield. There is a lot of potential downside if we did see spreads push out. So we are cautioning our investor base against adding more to IG credit. The outlook is quite good, but valuations seem quite a detractor within that asset class. And with regards to currencies, we are looking at the US dollar with interest. We think there is some level of downward pressure, more structural downward pressure for the US dollar ahead for 26 and throughout this market cycle. Japan is a currency we like, just given the strong fundamentals and valuations there. But currency, as you've seen over the course of this calendar year, or currencies in general, have also been quite volatile. So we are, I guess, advocating for some flexibility around the implementation from that point of perspective. So moving to the next slide, and I touched on risks. Some of the upside risks to our base case really focused on the level of productivity, CapEx spending, increased fiscal stimulus, but there are some key risks that really focus on that kind of left tail risk within overall returns. AI CapEx, we will talk about, and I know Tom will bring this up in his presentation around AI and specifically what some companies and some sectors are doing with regards to AI. But I'm sure we're all aware of the large CapEx spend. If this doesn't really, or if there are significant delays here, there are some issues with potential debt levels that could cause a major threat to our bullish case within equities, and certainly that is starting to play out with sort of Oracle at the back end of last year. There is a certain level of unknown in terms of how this CapEx spending will play out, and so it remains really a threat in our view in terms of potential significant upside for equities from here. Look, inflation, we expect that inflation will be relatively benign over the course of 26. However, if we did see an uptick, especially in the US, on the basis of a stronger labor market, of a more prolonged, I guess, tariff outcome, that would certainly put pressure on equities and the more of the bullish case from here. Geopolitics is certainly one we'll discuss today. It's very hard and very difficult to predict geopolitical scenarios and outcomes. But as you saw over the weekend, it can have quite a short quite a high level of shock and quite a short impact on some markets, especially commodities markets. So any prolonged geopolitical events like we are seeing in the Middle East would have quite a negative impact on our overall bullish case into 2026. And debt sustainability, and it's just really about the long-term viability of the US debt position and a number of other developed markets debt positions. This has started to come into fruition within markets. It's started to lend itself well to higher rates within the long end of the curve in the US. We saw a lot of the I guess the attention start to focus on the level of debt sustainability. That could also create a little bit of a left tail event or a little bit of a shock to US equity markets and more broad equity markets, and may, to a certain degree, undermine our long-term or 2026 thesis around being quite a bit more bullish. So certainly, we are positive for this 2026 calendar year. There are some key risks that we are taking into consideration that may pose a threat. And it really about, in our view, this calendar year is finding the opportunity, being flexible and being dynamic in terms of how you allocate. Just touching on more of a structural trend that we are seeing, and I know Tom will have quite a deep opinion and deep views around AI. We've seen it on the supply side with the growth of hyperscalers. We've seen it on the demand side around the intake around ChatGPT and the extended use within both firms and also extension to more personal use. It's a structural trend that's not going away. In our view, investors need to have a well inbuilt, I guess, outlook on AI, how it impacts their portfolio, not only in the short term, but the long term. And it also trying to access some of these themes and opportunities that our AI is presenting. And that's really not just within the IT, hyperscaler, large cap US market. It's really about trying to diversify across a number of different sectors and how AI is impacting the game there. And if we move to the next slide, probably one area that we've been having conversations with clients on is around healthcare. The sequencing of the genome, the reduction in costs there, the increased commercialization of that aspect of healthcare should certainly lend itself well to strong trends and strong alpha opportunities. The increased or the speed that drugs are discovered and go through the overall regulatory process, the increased manufacturing of surgical type instruments should certainly lend itself well to a number of tailwinds around healthcare. So, in our view, it's not just having this discrete and direct focus on the tech sector, large hyperscalers. It's really about sitting back and thinking, how is AI impacting a number of different sectors and asset classes that our portfolios are invested in? Because in our view, it's not just a limited subset of companies that will be impacted. It will be a widespread outcome here. And we are trying to sift right now through the winners and the losers, but it's really just about gaining an understanding of how things can change over the next market cycle. In terms of the next slide, we always get the question of, how are we actually accessing AI within portfolios? In our view, there's a broad set of opportunities, but there is some very, direct asset allocations decisions that you can make to take advantage of some of the AI themes that we are starting to see play out in markets. Public and private equity is certainly one of them, whether it's small cap public equity or more larger growth-focused public equity funds. Certainly, they'll be exposed to more of your tech sector, more of your hyperscalers, more of that direct exposure. Small cap equities, potentially more of these growth companies that are developing it at a rapid pace. And we think this is a good liquid exposure that you can have to developments around AI. Unlisted infrastructure, and even to a certain degree, the listed infrastructure market has really benefited from the aggressive rollout within data centers, the continued development of AI and machine learning. You've seen over the course of the first 6 weeks or the 6 to 7 weeks of this calendar year, listed infrastructure is an asset class which has certainly benefited not only from a defensive rotation, but there's strong tailwinds around AI. And we think it's an asset class that can certainly have structural growth trends as continued support comes in around the individual investments and the individual companies that managers are choosing there. Early stage VC or early stage venture capital, it is illiquid. It is to a certain degree quite difficult for advisors in the wealth market to access. However, we think this will be at the forefront in terms of AI development, AI innovation. We are seeing companies grow at an exponential trend these days, and we just think the flexibility and the access there will allow these strong structural trends that we are seeing within the AI market and allow investors to actually access that. So these are the three, standout asset classes in our view in terms of how to access AI. Now, that doesn't mean you're limited in terms of your overall asset allocation. One asset class that may not have your typical exposure would be maybe your fixed income or government bonds. However, in terms of accessing AI, we think broadly you'll be able to achieve that in your portfolio construction. However, there is an intense focus on being dynamic, choosing the right asset allocations and choosing the right managers to benefit from these long-term structural growth trends we are seeing within the theme.
Thank you very much, Andrew. That was a rapid oversight of the Mercer approach to this part of the market, the global equity part of the market, the part that's designed to deliver growth for clients. And it's now my pleasure to hand over to Tom King, who's the founder and Chief Investment Officer for Nanuk. I saw, Tom, that Nanuk had gone through $1 billion just recently for the first time. That's a milestone for every organization. So congratulations on that. So over to you.
Yeah, thanks, Toby. It was a nice milestone for us. Our flagship strategy, the New World Fund's just past 10 years of track record. Performance has been good recently, so we feel good about where we're heading and thankful for client support. I'm going to address the topic for today. It can't go on like this, can it? By talking about three sort of separate pieces of the puzzle. I want to start by just making some general observations about global equity markets and trends in recent years, uh, primarily because I think we have already seen in the last 6 and 12 months a shift in market behavior that is evidence that not only it can't keep going on like this, but it isn't continuing to go on like this, or certainly as it has been for the last 4 or 5 years. The second piece I want to talk about some of our observations around AI and implications for us as a stock picker in global equities, and how we're responding to what we think is going on, and how we're responding to what we don't know, which is as much of the picture as what we do at the moment. And then finally, I'm going to, I guess, frame what might be part of the Q&A and discussion around how to think about active global equity strategies today and selection of those strategies. And that's obviously coming from my perspective as a global equity manager, not an advisor or a consultant. But hopefully that provides some useful fodder for discussion. So starting with the market observations, there has been over the last 12 months and certainly the last 6 months more notably, a change in the relative performance of different parts of global equities. This chart shows 12-month performance of subsets of the MSCI World Index that show that more recently you've seen value and small caps outperforming, and growth and quality underperforming. Quality, certainly if you go back 18 or 24 months now, has reasonably significantly underperformed over that time frame. And that's a break in the pattern that we've seen over the last few years of sort of consistent and quite remarkable outperformance from growth and quality stocks. Uh, we see similar sort of trends and dislocations at a sector level. So if we look at the next chart, this is just an illustration of one example where software and AI tech-related hardware have diverged very significantly over the last 6 or 7 months, as concerns about the impact of generative AI on software as a service business models has resulted in a fairly sharp derating of many of those stocks. And that sort of type of dislocation related to what's going on with AI and some of the uncertainties about what that means for particular industries and companies is significantly more widespread than just software. The third trend I wanted to look at, Toby, on the next slide, was something that I think is a little less evident to the broader market, but certainly very important from the way we think about investing. And this is looking over a slightly longer time frame at the performance of different industry groupings, in this case going back a bit over 3 years to the point that ChatGPT was released. And not surprisingly, since then you've seen AI related stocks perform very strongly, and not without reason. But there've been a very wide range of more traditional industrial type parts of the economy progressively underperform very significantly over the same time frame. And the narrative in the market is largely that is because they're not AI winners. When in fact, I think what is going on here is something a little more rudimentary, that we have a set of industries that had significant upsides during 2020 and 2021 during the COVID period, as supply chains readjusted and people built out capacity and inventories to deal with the situation at that point in time. And you've seen a very large number of industries across the economy in significant cyclical downturns since then, and those are inevitably likely to end with companies resuming more normal rates of growth and normalization of profitability over the next 2 or 3 years. And some of those are areas of significant investment interest. And not surprisingly, looking at that chart, if you're looking for return potential and attractive valuations in global equities, you can find it if you start going looking selectively in different industries and regions. The second set of observations was a bigger picture one over a longer period about the change in the composition of global equity indices. So this chart shows the percentage of the MSCI All Country World Index made up by the top 13 or 14 tech stocks, which include all of the top 10 largest positions in that index today, as well as a couple of the recent strongly performing memory stocks. And that's an extraordinary change in the composition of the index, as it's gone from about 6% 10 or so years ago up to over a quarter of the index today. And those companies are by and large growing reasonably quickly and at very high rates of profitability. So are growthy and quality type businesses. And that's changed the overall characteristics of a global equities passive portfolio to be more growthy and to be higher quality. And because of that, the characteristics changing, the valuations of global equities have gone up in a way that is absolutely logical in relation to the fundamentals. The next slide shows the sort of related effect of this increase in exposure, which is that part of the market, which is now a quarter of it, has done extremely well, particularly over the last 5 or 6 years. And that's been a big driver of global equities returns, particularly passive global equity funds. And the question is rightly, is it likely that that can continue? With a lot of people's assumption being that because of that degree of performance, that things would be expensive today. And that's not necessarily the case. So the next slide shows the same time frame, the last 10 years, and the forward PE of that group of stocks, which has risen from a couple of ticks higher than global equities 10 years ago to a slightly more significant premium. But when you take that in the context of a significant improvement in the return on equity of that group, and that group now growing quicker than it was relative to the market 10 years ago, that PE isn't necessarily that expensive. And certainly over the last 5 or 6 years, the outperformance has been driven by real growth in earnings, not PE expansion. And if we go to the next slide, as an active stock picker today, this is what we see and look at. If you look at global equities, excluding that cohort of stocks, the market's trading on a 2-year forward PE of about 16 and a half times. And that 75% of global equities is delivering average revenue growth of about 8%, with a return on equity of 16, which is a bit higher than global equities over the long run have been able to do. It would be arguably very slightly more expensive than normal, but not statistically very expensive priced like that. When you look at the large AI-related tech stocks, and I'll focus particularly here on NVIDIA, it's trading on a lower forward PE, notwithstanding revenue growth at twice that rate, and a return on equity that's very significantly higher. So it's not sort of evident when you look from a bottom-up perspective that these stocks are overtly expensive in any way. And in fact, the decision to allocate to those has a pretty sound fundamental basis, provided that you believe that growth and those levels of profitability can be sustained for some time. Which is a good segue into sort of observations about AI. The first thing I wanted to start with here was a chart from the IT consultancy Gartner, who publish industry reports across the broad spectrum of technology industries. In this case, it's a chart of expectations for the growth of various AI-related technologies. And this was published a month or so ago. What stood out to me here was something that's very consistent with my personal experience within our business and what I'm observing in companies that we speak to and invest in, that there's a very high level of hype and very high expectations about the potential for agentic AI, which is sitting at the top of that peak of inflated expectations. And what is quite normal in these cycles is that at that point, stocks related to those trends become expensive, and that those expectations, in this case, for very rapid, very pervasive adoption of agentic AI solutions in business, back to Andrew's comments, displacing large parts of the labour force, are perhaps not likely to be met over the next couple of years. And I think we are starting to see sort of evidence emerging very quickly that whilst AI agentic solutions are no doubt going to be pervasive in business, that they will have a profound effect on our jobs and employment over the longer term, that deploying agentic AI within large companies and even within small ones like ours is something that's very difficult to do in a secure, reliable, and regulatory compliant way. And as that challenge is presenting itself, it's going to influence the way people think about different AI exposed stocks. If we move to the next chart, if we step back from that, despite agentic AI perhaps not being, not replacing everyone's jobs in 2026 or 2027, we think that the extraordinary levels of data center investment you're seeing in the US and now around the world are likely to continue. And that's for a couple of reasons. Firstly, that until building bigger AI foundation models shows to not produce better outcomes, companies are very likely to continue doing that. And so there's a race to build the best AI models and to achieve super intelligence. And whilst that continues, more and more money is going to be spent on building the data centers in order to train those models. Secondary to that, you're starting to see more investment in capacity for inference rather than training those models. So as we start to use more AI solutions, there needs to be substantially more capex going into building data center capacity for using those models in solutions, and that investment's accelerating and going to be very large. The second general observation is that this is really a profound economic phenomenon. It's not just a bubble based around technological curiosity, that the models that we have today, which are evolving very quickly, are extremely good and extremely capable and have very wide use cases even as they are today. But alongside that, there's more than one of them, that any one of the major providers of the large language models has models that are capable of being used in a commercial context effectively, and you can easily switch between them. And that has pretty profound impacts on the sort of or where value might accrue within the AI value chain. And at this point, that's an unanswered question. There's obviously hundreds of billions of dollars being spent to develop AI models and AI-related businesses. Whether that capital investment will achieve good returns on capital is a question that's yet to be answered, and there's significant uncertainty about it. As I've mentioned, there's emerging challenges about implementing agentic AI, and the other trend that I think we'll hear more of this year is about physical AI, using those models in robots and in cars and so on, where they will start to control things autonomously, and that will be an important investment trend. We go to the next slide. There's still a lot of unknowns in AI, and our approach is to avoid taking significant bets on things where we don't think the answers are or can be known today. That includes things like when these models stop getting better and what the influence of governments around the world will be on how the models are allowed to evolve. And finally, on AI, just a quick snapshot. Our approach here is to avoid taking bets where we don't think we can be confident about whether companies will benefit from AI, and look up and down the value chain and towards the beneficiaries in other industries of the adoption of agentic AI solutions, and that covers a fairly wide range of different types of businesses. Moving on to the final section, and this perhaps a sort of framework to think about where active management fits in today. Clearly, passive strategies have done extraordinarily well over the last decade, as you've seen larger cap stocks performing very well. And some of the approaches applied by active managers haven't worked so well over that sort of time frame. And I think the observation I would make is that advisors putting together portfolios tend to follow sort of one of three approaches. They're either allocating entirely to passive global equity solutions because they're cheap and because they've performed well, and that has proven to be a very successful strategy over recent years, or they're doing that and using satellite strategies around the side to add alpha and potentially diversification benefits, or they're putting together blended portfolios of style-biased strategies that fit well together and diversify effectively. And the framework here, I guess, challenges people to think about if they're selecting active managers in core satellite or blended portfolios, what is it that should guide that decision? And the I guess observation I would make is that most active managers tend to filter their investment opportunity set around a particular type of factor. So value managers focus on lower price book, lower PE type companies, often more low growth, cyclical type industries. Growth managers, different from that, higher growth. Quality managers skew to higher financial quality and other factors, small cap and so on. And the outcomes for those types of strategies tend to be dictated by whether those factors perform well during particular periods. And so if you step forward to the next slide, if you look at where we're at today and the recent performance of some of these factors, you can start to think through what scenarios would need to occur in order for those active strategies to deliver good returns. And if we go to the next slide, in conjunction with that, I wanted to show a piece of work that we did or about 2 years ago, which I've just updated, that looks at the relative valuation of each of those factors within global equities over the last 25 or so, nearly 30 years. And what is the relative valuation, so relative PEs, which have been adjusted for the differences in growth rates and return on capital and cost of capital of those components of the market. And it shows, not surprising, were very expensive during the dot-com bubble back in 2000. It showed that at that point that value stocks and small cap stocks were relatively very cheap. And that preceded a decade of returns in which value and smalls significantly outperformed growth. You had the reverse situation in 2009, 2010, where quality and growth stocks were trading at relatively attractive valuations, in fact, very similar PEs to value stocks, notwithstanding they were likely to grow or be much higher quality going forward. And that's preempted a period of 10 or 15 years of outperformance from quality or growth. Going back 2 years, quality was starting to look very expensive, and you've seen a period of underperformance recently since then, and growth was slightly expensive, and the same thing has happened. You've seen more return in performance of value. And if you apply that same logic in terms of valuing these factors today, it would show that the recent sell-off in growth and quality make those areas that are probably worth revisiting, and that value may be in fact expensive unless you see an improvement in the returns and growthiness of that part of global equities. And I'll wrap up there, Toby, and hand back to you.
Thank you. Thank you very much, Tom. That was a lightning pass through a number of topics. So, Andrew, if you'd like to join us, I wanted to come back to this issue of the geopolitical events of the weekend, and not so much to ask what Mercer think will happen, but more how Mercer responds in its thinking about portfolio construction when there is an event of this type, a relatively unexpected major event with unknown consequences.
Yeah, so we're a multi-manager, right? So we have, vast diversification across the portfolio, whether it's, long oil positions to, long global equities positions. So if there is a significant downturn within broader growth or risk assets, our portfolios aren't significantly, don't see significant underperformance. What we tend to do is reach out to the managers that we do employ within the portfolio, get their views on certain parts of the portfolio. We don't expect a significant kind of turnover. That would probably raise some concerns around the managers' existing positions. Geopolitics is always something that's incredibly difficult to predict and know the timeline around that. So whilst in our view, the portfolios are well diversified, we are seeing some aspects, actually improve on the news, some parts of the portfolio detract. For us, it's really trying to digest the news and trying to, predict to a certain degree how long this is going to be within markets. Certainly overnight, we've become a little bit more anxious around probably the longer term impacts here, more a prolonged, I guess, outlook with regards to the disruptions within the Middle East. So we are looking ahead and planning. But when we do see kind of these geopolitical shocks, there isn't a significant change that immediately occurs, not only from a diversification perspective, but also from the fact that we're not trying to chase, 1 or 2 or 3 day short-term return profiles within markets.
And so you mentioned that you don't expect to see churn or major turnover in the managers, but what do you expect to see from your global equity managers in their response at a time like this? And to what extent do you look for any sort of consistency among and between the managers in a portfolio?
Look, we would expect them to perform, how or to their investment strategy, right? So during these periods of kind of risk off, you generally see, I guess, defensive equities performing quite well in terms of the certain sectors. So, on a short-term impact, we'd expect to see those portfolios which are a little bit more managed to a volatility target do well. In terms of the question around I guess what we do expect to see managers produce, we expect them to know how this would directly impact their portfolio. They would be across various levels of scenario analysis, stress testing. The Middle Eastern conflict has certainly been around, at least in the most recent times. So, in terms of pockets of their portfolio, we definitely wouldn't expect to see most managers overly exposed. The direct impacts around, Northern Africa, Middle East from an equity position or a regional perspective is fairly low. So we wouldn't have a significant, I guess, negative impact. But we'd like to see, an outlook in terms of not only, how this impacts the portfolio, but if we saw a prolonged, I guess, escalation in the Middle East, what changes they'd be looking to make, what opportunities they could potentially take advantage. And that could be simply, moving to cash in some more high beta positions. But we'd expect a certain level of active management and an active kind of correspondence. And we've certainly got that from the managers we've deployed within the portfolio so far.
And Tom, as a stock picker, I mean, how do you respond when you open the newspaper on Saturday morning, or and lo and behold, there's something like this?
On one hand, it doesn't change what we do, and on the other, we sort of have to think about it deeply in terms of how it might affect the sort of scenarios we're thinking might play out. Our process is very much bottom-up stock picking, trying to find businesses that we think will outperform for reasons that we can understand over medium-term timeframes. And what we generally seek to do at a portfolio level is not be taking sort of significant bets on things that we uh, don't understand or can't know the answer to. And something like how the war in the Middle East is going to play out now is something we can't know the answer to. No one can. And the outcomes for equities will be very different if that escalates into a regional conflict that drags on for a long time, or it gets wound up, there's some form of stabilization and resolution in the short term. And we don't know, we can't know, and we don't want to position the fund in a way that the investor outcomes get dictated by that. So we're watching it very carefully. To the extent we think it's likely to start impacting the industries we focus on, supply chain disruption, higher energy costs, and so on, we will look to how that should affect the shape of our portfolio, but more so, where we're getting better opportunities as a result of market dislocation. So that the big thing is we're running a process that is ongoing every week, every month, screening the world to find opportunities that we think are attractively priced. And where you get dislocations in pricing associated with events like this, it tends to create those types of opportunities. And if you find opportunities to, that are better than what we own in the fund today, we'll make changes.
Yeah, obviously the most obvious second order impact of this event has been on the oil price, and we're already starting to see that play out a little and to be talked of more. You don't have that sort of fossil fuel exposure directly in your portfolios, Tom, but do you try and you mentioned energy just a moment ago, or energy costs a moment ago. Do you try and think through the consequences, the sort of unexpected consequences of these types of events on, say, chemical manufacturing if gas supplies are affected?
I mean, we do, and a good example would be sort of what's the impact on things like renewable energy development around the world. And it's very nuanced because higher energy prices probably push through to higher rates, which has impacts on financing of projects and viability. On the flip side, higher energy prices means higher electricity prices in many parts of the world, which promotes renewable development. So it can be quite nuanced. And yes, the oil price, not surprisingly, has risen very sharply, but whether it continues to go up or whether it comes back is something that is not sort of our area of expertise. And so we try and avoid sort of taking a bet on that within the portfolio.
Andrew, you talked at the start of your presentation about being relatively bullish on the US. But let's talk about Asia a little. I mean, US growth is surprising on the upside. Corporate earnings, as you and a number of the other presenters pointed out, have been pretty strong. But how do you think about Asia as a long-term structural driver of growth?
Yeah, look, in our view, Asia or emerging markets in general is an opportunity within equity markets. Certainly, not only the growth that we are seeing, but a number of the corporate governance reforms are really being well supportive of both the Chinese and the South Korean equity markets. We've also seen, a significant price action over the last 12 months with those two regions. But given valuations, there's certainly a strong consideration that will continue. For us, I guess China, Korea, Taiwan will also be at the forefront of AI productivity, AI development. So certainly if you want or investors are chasing kind of that growth aspect or growth exposure, emerging markets is certainly a region that that should be under consideration. Japan for us, I know sticking to that Asian theme is certainly an attractive opportunity. The large fiscal stimulus within the region, corporate governance reforms, the diversification that equity market offers certainly looks attractive for us. So whilst we are fairly bullish on the US and developed markets in general, EM is certainly one which we think should be included in client portfolios. In our view, we tend to benchmark it relative to the equity, so around an 11 to 12% allocation within global equities. We may overweight or underweight that position given DAA views, but in terms of total portfolio construction, emerging market equities certainly should, in our view, be a default allocation, not only from the growth aspect, but a lot of the reforms that are going on within certain region that should provide quite strong tailwinds as we head into the next market cycle.
So in your role as asset allocator and manager selector, when you develop a view like this, do you either expect to see it reflected in the manager's portfolios, or do you say, right, no, we're now looking for specific exposure, we're going to add a manager or replace I don't know, a more European focused manager with an Asian focused portfolio manager?
Typically, at this stage, we are just taking a direct exposure to emerging markets. So that's not a direct exposure to Asia as such or China. So within emerging markets, we're also talking about LATAM, Eastern Europe. So it is more of a broad-based exposure. But with that, I guess, single manager allocation, we are looking for flexibility. We want the manager to certainly go overweight certain regions, overweight certain sectors where they see fit over the cycle. For us, it's really just about having that allocation. If we did want to implement a particular overweight view, we may look to have a short-term overweight to an index or an ETF. We are expressing that right now through Japan.
Right.
So there is some flexibility in terms of how we implement it, but we do at this stage still currently like that broad-based emerging market manager with that mandate, rather than having that structural allocation to say China and going through the levels of volatility there.
And Tom, what about yourself? To what extent? I mean, you're a thematic manager in the sense of trying to ride the underlying structural changes in the economy. To what extent do these sort of geopolitical issues around Asia, for example, or Asian growth play into your stock selection?
Yeah, so look, we're trying to capitalize on the growth across a set of industries and technologies, and some of those value chains sit in Asia. Our process is primarily bottom-up stock picking, and we do see attractively priced businesses that are sort of benefiting from those trends and are leaders in those industries, and we do own them in the fund. We have been overweight in Asia and in Europe for quite a long time within the strategy, driven by that bottom-up stock selection and seeing what we thought were better priced, better valued opportunities in those regions. But we also place some constraint around how far away from benchmark we can allow those regional and country exposures to be, because the last thing we want to do is deliver surprising outcomes to Andrew and his clients, to the people who use the fund. There's no, I guess back to the question that you asked, Andrew, there's not much point expecting your active global equity managers to be looking at EM opportunities and delivering that for you. It's not much use to you if EM performs well and that exposure wasn't there for you. You need to know what you're buying, what's on the can, and that's what it's going to deliver if the scenario plays out as you'd hoped.
And what is that? You mentioned the benchmark there. What is that benchmark for you? MSCI?
We use a general global equity benchmark, so MSCI All Country World Index, so including the EM, and we do have exposure to stocks in places like Korea and Taiwan at the moment, which has been good for us and our clients.
Now, Tom, you talked a little about the dispersion of returns between different sectors of the market. I mean, this is probably a bit of a Dorothy Dixer to both of you, but to what extent do you think the state of the market at the moment, makes the case for active managers rather than passive exposure? Andrew? Yeah.
Yeah, look, I think in these types of environments, you would expect that active management should outperform, just given the level of dislocation, the level of rotation that we've seen over the course of this calendar year. We'd expect that, I guess the end for the Mag 7 rally to a certain degree. This is really where active management should shine. It should take advantage of some of the opportunities that are within markets. For us, dislocation and dispersion is certainly a thematic which is structurally inbuilt in terms of our portfolios as well. So not just the equity markets, in our view, alternatives and whether it's CTA or global macro, the environment certainly over the next market cycle around dispersion should lend itself well to tail risks within these asset classes. So active management, in our view, is certainly favorable in this type of market. We continue to deploy active managers in the portfolio, whilst we are aware of risk management. I think you have to be to a certain degree these days. We think active management should serve its purpose where there is uncertainty, where there is dislocation and dispersion.
And Tom, you talked about not wanting to stray too far from the benchmark. I mean, to what extent, as an active manager, do you also adopt a sort of an active share approach to
Well,
the portfolio?
so good question. We run a very high active share fund, typically around 90% active share, which is obviously radically different from the benchmark. But I guess what I referred to earlier was the risks. It's not necessarily the holdings the holdings we have are very different, but you're trying to manage a set of risks against the benchmark: regional exposures, industry exposures, oil price exposure, interest rate sensitivity, those set of risks. And they can be managed with different sets of stocks. You don't have to hold the benchmark. I think around active versus passive, my view would be good active managers can outperform at any point in an equity market cycle. But because, as I said earlier, most active managers gravitate towards subsets of the market that are very heavily style biased, and those particular styles tend to perform during periods where specific sort of macro factors are at play. That your active, the chance of your active managers outperforming is very much dictated by your choice of which type of active manager you're allocating to. So allocating to quality managers 2 years ago, it was going to be extraordinarily difficult from the starting point of how that part of the market was priced for those managers to do well. Similarly, allocating to a value manager in 2012, it's however good they are, it's going to be very difficult for them to achieve good outcomes. So I think part of it's about selecting managers who have skill, and part of it's about being conscious of what's going to dictate the outcomes for an individual manager. And look, our strategy, we hope, can deliver fairly consistently through market cycles and variations in interest rates and currencies and things like that. There are scenarios where it won't work so well. But that's the table I showed earlier, was a sort of snapshot of how you might go about thinking about that.
Look, thanks very much, Andrew and Tom. Let me just finally share a reminder of the upcoming of the Portfolio Management Conference. So if you didn't get a chance to take a screenshot earlier on, here's an opportunity for you to take a screenshot and get more detail on the IMAP Portfolio Management Conferences in Sydney and Melbourne. They will be streamed, but we would welcome you as a live member of the audience in each city if that's of interest. So thanks very much for your time. Andrew Stewart from Mercer, Tom King from Nanuk. thank you for your time, for joining us today. For those of you who've joined us through the webinars, either today or through the series, thank you for your participation. We welcome your feedback, and each of you will get a SurveyMonkey questionnaire shortly, and we welcome your suggestions for future topics, and we welcome you being further involved in IMAP events through the rest of this year. So Andrew and Tom, and to our other presenters, thanks very much.